Welcome back to our second presentation on stocks. Exciting stocks, sexy stocks, risky stocks. And in this presentation, we'll take a look at the securities marketplaces and securities. Also, how we measure how well stocks are doing and measurements about individual stocks. So let's start on slide 18 with securities market. What a silly name, securities. Well, it's an unfortunate name, like the name stock for a company. Security is a fancy word for a financial investment that can be traded, can be sold, bought and sold. And where are these securities? Stocks are just one type of security. Where are they sold and bought? On the New York Stock Exchange, the big board, the NYSE, started in 1792 when Wall Street really was on a wall in lower Manhattan. It is now owned by a derivatives trading firm in Atlanta. What? Well, it's an interesting history that we delve more into in Introduction to Investments. And now the New York Stock Exchange is no longer the dominant force. It's one of the two dominant forces in the United States. For many decades, the little kid on the block, literally down the block, actually starting outside the New York Stock Exchange, was the American Stock Exchange, the Amex, the Curb. Yeah, they called it the Curb because these people started out on the street outside the New York Stock Exchange. They'd look in the window and see what was going on, and then they would trade. It gets pretty darn cold in the wintertime and very hot in the summertime. So eventually they moved down the street, and then they were bought eventually by a couple different groups, but eventually by the New York Stock Exchange. So now they call it the New York Stock Exchange American, but everyone just calls it the American. Now, it was tiny compared to the New York Stock. It still is. And most of the stocks that sold on the Amex were very small companies. Some were not very, very speculative, not very legitimate. And so the Amex just wasn't a place where people bought and sold stocks for the big companies. Well, what happened? Along came the NASDAQ, which is a kind of a silly name, but it stands for National Association of Securities Dealers Automated Quotation. Actually, it doesn't even stand for that anymore. They don't want you to even remember that they were part of the National Association of Securities Dealers because now they're the NASDAQ. And the NASDAQ started out in the 1970s and attracted the attention of the tech companies. Some of you may have heard of Microsoft, Apple. Yeah. Yeah, and then Intel and Oracle. You've probably not heard of Oracle, but now they're on the New York Stock Exchange. And then companies like Google and Amazon, right? So when we talk about the NASDAQ, even though a lot of the companies on there are not tech companies, we usually are talking about the tech sector. And so what we find is the NASDAQ was exploding in the 1990s with the dot-com bubble and then imploded in the early 2000s. But now the NASDAQ is much stronger because many of the companies on it are very strong. And so it's a two-horse race between the New York Stock Exchange and the NASDAQ. And what they're doing is they're pilfering one another. As I said, Oracle, which is a big tech company that maybe you've heard of, maybe you haven't. They used to be on the NASDAQ. Now they moved over to the New York Stock Exchange. AMD, which is a competitor to Intel, microprocessor manufacturer, they were on the New York Stock Exchange, and now they moved to the NASDAQ. So the two companies are the two entities, New York Stock Exchange and NASDAQ, are fighting to have companies use their exchanges. They're not for profit organizations, folks. Every time a stock is traded, they make a tiny little bit of money, but there are billions of transactions every day. So yes, they are very lucrative entities. Now there's a third market called the over-the-counter market. And folks, you want to stay away from these. By the way, when I say third, New York Stock and the American Exchange are basically one type of market, so they get lumped in together. The NASDAQ is its own. And then the third, the over-the-counter market, are where the penny stocks that we talked about, the wrong side of the tracks, the red light district, stay away from the penny stocks. For hundreds of years, these marketplaces were, and still for the New York Stock Exchange, even though I think it's just there for television, centralized locations. That's where you saw the people screaming and hollering at one another and throwing things and paper flowing everywhere. But no. There's only a few people left on the floor of the exchange doing transactions. The vast majority of transactions occur electronically. The centralized locations, I think they're just there for television so that they can take pictures and have something on the nightly news. But although the people on the floor say, no, we're still important. I don't believe them, but that's what they want to believe that. I think it's there for television. Now, that's where the stocks are traded. How are the stocks doing? Well, that's a difficult thing to do. How do you know what the condition of the stock market in general? Well, because there are thousands of different companies. There are indexes, benchmarks, standards that we use to gauge the market as a whole and various sectors of the economy. Now, these are the big three that you often will hear about on television, on the news, on the internet. The Dow Jones Industrial Average, 30 of the largest and best known companies in the United States. It started in 1896 and actually started with only 12 stocks and then went up to 20 and now it's 30. It's the most published, the most popular, but folks, it's not the best. It's only 30 stocks. So a better one is the Standard & Poor's 500. These are the 500 largest companies in the United States. Now, there's a little bit of finagling going on, and this one has its problems, but this one, in my humble opinion, is the best because it shows you how the top 500 companies, folks, in terms of wealth, make up, I think, 80% or more of the entire stock market in the United States. So it's very popular and very important. The NASDAQ composite is comprised of mostly high-tech companies because most of the high-tech companies have stayed on the NASDAQ. And so when we hear about how the NASDAQ did, we're usually talking about the tech sector. So you might hear people say, the Dow Jones and Standard & Poor's went up, but today the NASDAQ went down, which means the big companies, not necessarily mostly tech companies, did well, but the tech companies on the NASDAQ did poorly. And this is what was going on in the late 90s. The NASDAQ was flying higher and higher and higher, and the Dow and the Standard & Poor's kind of stayed behind. And then when the dot-com bubble burst, the NASDAQ was cratering, and the old economy stocks, the old economy companies as they were called, they held up. And the same thing is kind of happening in 2022. You see the Dow mostly holding up, and the Standard & Poor's to some extent, but the NASDAQ is getting hammered. So, slide number 20. Here are some other indices that are not as important, but we will discuss them in detail, more in detail, not as much detail as we do in the Business 123. Apologies, folks, but really, we spend over 1/3 of the class in Introduction to Investments just in stocks, and then stocks spill into other parts. So it's basically half of the class is dedicated to stocks because they're just so important. And so there's so much wealth of information to learn and study, and it's just a lot of fun. But these are other indices. Here is, remember we said the S&P 500 was about 80%. Well, to get the whole 100%, they have what's called the Dow Jones U.S. Total Stock Market Index. What a stupid name. It used to be called the Wilshire 5000, but they kind of took over Wilshire and kicked them to the side. It's approximately 4,000 stocks. Well, it varies. One time it was 7,000 stocks. It was started out as 5,000, and now they said, it's just too many to keep track of. So now it's 4,000 large, medium, and small companies. And they're designed to gauge the entire stock market. So you might hear people call it the total market index. How do we know how small companies are doing? Well, that's the Russell 2000. They take the top 3,000 companies and lop off the top 1,000. And what you're left with are the top 2,000 to 3,000, 2001 all the way up to 3,000 company. Now, how do you gauge what's going on outside the U.S.? Well, that's interesting. For many years, there was the World Index, MSCI, don't worry, it stands for Morgan Stanley Capital International. Don't try to remember that. World Index. And the EFA, that's how it was pronounced, EFA, Europe, Australia, and the Far East. But the problem with these two is that they did not include the developing nations, the emerging markets as they're called now. And so instead of just rolling them into the world in the EFA index, they've created two new indexes with even worse names. The All Country World Index and the All Country World Index ex-USA. Oh, they didn't ask me. I would have told them to call them the world, and maybe the EFA is okay, international or overseas. Sometimes people call it whatever. It's not I'm not in charge. But we'll come back to these guys later on when we discuss mutual funds, specifically index mutual funds, and that's in a couple of weeks, folks. Stick with us. Okay, now, what's a bull market? What's a bear? You've heard it, right? A bull market, bulls charge ahead. They throw their opponents up in the air with their horns, whereas bears knock down their opponents with their paws, and bears are more reclusive. They don't really like to be out in the open. They much rather sneak up on you. And it's, bear market is when stocks have fallen 20% or more. If they only fall 5 or 10 or 15%, we call that a market correction. Oh, big deal. It still means the markets are going down. We know that most of the time we're in a bull market. Stocks have increased over the last 200 years as our standard of living has increased, as the economy has grown, and our technology has flourished. But sometimes history tells us we're going to hit a bear market. Usually we hit a bear market when people are saying, "Ooh, is it too late to get in?" Right. Yeah, that's how it works. Yes. And when people are saying, "Oh, is it too late to get out?" That's when the next bull market's about ready to start. So you have to remember that emotions are not your friends when it comes to investing. That's why Warren Buffett likes to say investing is simple, but it ain't easy. Okay, now let's take a little bit of time and do some stock analysis. Where do you start? Well, there are dozens of, just so many different numerical measures and strategies and theories and formulas and models, we call them, to value stocks. It's not a science, folks. There's a science part to it, but there's also an art part to it. And interestingly enough, some of the best investors I've ever met have been artists, which is really amazing. Often that's such a strange, not necessarily strange, because there's an art to investing as well as a science. And we're going to talk about the science part because that's the easy part. All you need is a 99-cent calculator. The author of The Intelligent Investor, Benjamin Graham, who was also, by the way, Warren Buffett's teacher, said, "Show me the numbers. Let's see how the company is doing." Because often you just hear about people say, "Oh yeah, we think Apple's a great company." Well, Apple is a great company, but is it worth what people are paying for it? And that's a whole lot harder issue to come up with, isn't it? Some of the popular measures are the ones we'll take a look at in this presentation. Capitalization, which is a fancy word for what's the company worth. Book value, what's it worth on the books. It's going to look a little familiar, folks. Earnings per share, because companies are in business to make money. And then we're going to take a look at its price relative to the earnings, the PE ratio, price to earnings ratio. and the dividend yield, or sometimes called the current yield. And these are very straightforward, folks. I hope to show you that once you get started investing, and once you get started investigating stocks and the measurements that we use, you're going to find that it's pretty straightforward, pretty easy. In fact, it's easier than bonds. The tough part, exactly, the tough part is deciding, is this company worth what people are paying for it? What is the future like? What do we believe is going to happen in the future for these companies? Because, nothing stays the same, right? Everything changes, and prediction is difficult, especially about the future. That's been attributed to Mark Twain, but it probably was said by Niels Bohr, who was a physicist. Anyway, it's a great quote. Prediction is difficult, especially about the future. Okay, so let's take a look at the first one, market capitalization. Market capitalization is a fancy word for how much is the company worth. Everybody keys on the price. Wrong, 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 wrong. The price is irrelevant until you know how many shares of stock are outstanding, how many shares there are. Then we know how much the company is worth. It's a very simple calculation, and we don't have to do it, actually, because all you can do is look it up on the internet. But you take the number of shares outstanding, number of shares that are out there in the world, times the current price of the stock. And that's what the company is worth. And there are three categories: Papa Bear, Mama Bear, Baby Bear. Now, these categories are squishy depending on who you talk to. But now what you hear more and more people talk about is a company is not a large cap stock until it's worth at least $15 billion. Huh? Oh, dear students, there are companies that are worth far more than $15 billion. Yeah, remember I told you about that one share of FedEx? Yeah, you get one lug nut. So once you've reached $100 billion or $200 billion or now $1 trillion, you are called a mega cap stock. But if you don't remember that, that's fine. Just remember large cap, Papa Bear. The mid cap stocks, many of them you heard of, some of them not. They used to be, 1 or 2 billion up to 5 or 6 to 10 billion or so. But now you hear people say, well, it's got to be at least 5 or 6 billion up to 15 billion to be a large cap stock. And so don't worry about getting the numbers perfect. Realize that there's a range of amounts. So these are the mama bears. And some of them you heard of, and a lot of them you haven't. Small company stocks or small capitalization stocks. Most of these you have never heard of. And it used to be up to just a few years ago, $1 or $2 billion was small cap. But now you're hearing people saying, oh no, 5 or 6 billion is a small cap company. And then they get into the micro cap. Anything less than about 100 million down to 50 million, those are called micro cap. It's a subcategory of small cap, just like mega cap is a subcategory of large cap. But you don't have to worry about it. If you remember it, great. If not, when you're talking to some folks who are savvy about investing, they might say micro cap, and you say, well, that's a very small cap company. And then, again, not to be discussed in polite company are penny stocks, which typically sell for less than $1 or sometimes less than a penny. That's why they call them penny stocks. Stay away from them. Now, every once in a while, a company falls on hard times. As we said, Chrysler went down to $3. Ford went down to under $2. Are they penny stocks? Well, they're more turnarounds and maybe goners because a lot of them don't survive. But when we talk about penny stocks, we're talking about companies that really aren't companies. They're just scams there to take your money. So stay away. Okay. How do we do this? Well, with your 99-cent calculator, you can multiply a company that stock price is $50 times the number of shares outstanding. You see, if we know the price is $50, that doesn't tell us anything. It just tells us, yeah, the price is $50. But if we don't know how many shares there are, we don't know what the company's worth. So if we had a company that had 2 million shares that were out in the world trading between investors, and the price were $50, we'd multiply 50 times 2 million, and you can even write the word million. You don't have to write out all those zeros. And you get $100 million or 100 with a word next to it, million, because if you put down 50 times 2 and then the word million, we do that in the face-to-face class, and you can do it when there's a worksheet I want you to work on, and there's a commentary and an answer key. So this is a small cap stock. In other words, if you wanted to own this stock, you'd need $100 million in your pocket, and then you'd go down to wherever it's being traded and say, hey, I want to buy this stock. Well, it doesn't work that way. If you want to take the stock private, which means you want to own all the shares, you have to put in what's called a tender offer, because there's a lot of hanky-panky that goes on in the world, folks, in this world. You'd have to show up with about $120, $130 million and say, I want to buy this stock. I want to take it private. And there's a set methodology for how these things happen. And you might have heard of it. You might hear it in the news. Elon Musk wanted to buy Twitter. Well, he needed to come up with a much bigger price. And then after he said, I'll pay you, what is it, 40 million something? 40 billion, I'm sorry, $40 billion for Twitter. He kind of went, well, really, Twitter ain't worth 40 billion. Too late. You signed the contract. You said you were going to do it. Now there's a way to get out, but then they will hit you with like a $2 or $3 billion fee, cancellation fee. So he didn't want to pay that. And he didn't really want Twitter. And then he decided, yes, I do want Twitter. So who knows? We'll see how it all works out for him. I wish the guy a lot of luck, because he's an amazing guy, but he's also pretty crazy. I guess that's how he got to be who he is, by being pretty crazy. And we'll see how that works out. Okay. And we'll see some examples in just a bit. Stick with us. Now, numeric measures to consider when evaluating a stock are the book value. Book value, that sounds familiar. That's the net worth of the company, determined by deducting all the liabilities from the corporation's assets and dividing the remainder of the number of outstanding shares. In other words, remember, our assets minus our liabilities was equal to our net worth. Yeah, you remember that. Well, the same thing happens in corporations, except there's a whole lot more zeros at the end. You take the assets minus the liabilities, and you get what is left is called book value. And because that's what it's worth on the books, not necessarily what's going to happen if they were to try to sell the assets, which is what we talked about when we put down the assets on our balance sheet, on our net worth statement. Because maybe when we actually go to sell the furniture, we're not really going to get what we think it's worth. And same thing is true with corporations. But in reality, the book value is very rarely close to the market price, the stock price, because a company is worth more than just the assets on the book. If you were to look at a pizza shop, the shop, if it's successful, is worth far more than the chairs and the pizza ovens and the utensils that they have. If you were to sell all those things, you'd get, very little of what, if it's a successful business, what it's worth. And the same thing is true in the world of corporations. If you were to liquidate the company, you would probably get far, far less than what the company is actually worth, because it's a company in business and it's making money. Does that make sense? I think so. Think about it. It's just a whole lot more zeros after the numbers. Now, what happens if the stock price gets below the book value? Well, now that's very dangerous. Why? Because the company is in danger of being raided for the assets and put out of the business. And you might hear corporate raiders or takeover artists or private equity firms. These are people who go out and look for companies that are on hard times and have assets on the books, book value. And so they go in, they swoop in, they sell all the assets, pay off the debts, and put the company out of business. That's capitalism. And if you're one of the workers who've been working there for 22 years and now all of a sudden you're out of a job, you're not happy about this. So you go to your elected Congress bozo and say, I'm not happy about this. And they say, well, here's unemployment check. Go find another job. Because this is what we want to happen. It's not always life affirming, we might say. But capitalism says, no, you don't understand. That company had locked capital. That capital was not being utilized. Capital is the fancy word for resources, money. That capital is not being utilized well. So these individuals were unlocking the capital. And think of it like plowing under the crops from the year before. And part of that capital is you, the human capital. Those people who are working at that business that's failing, they need to be better utilized. And that's why we have unemployment insurance. Don't let anybody tell you that we have unemployment insurance to pay people not to work. No, we want them to go find a job. But in the meantime, we want them to have food on the table and clothes on their back and not get kicked out of their home. And so that's the reason behind unemployment insurance. So capitalism, it's not perfect. It might be the worst possible economic system ever created, except for all the others, right? Yeah. So, humans, everything we've done is not perfect. We do our best to make it better and better and better. And if something comes along that's better than capitalism, fly it up the flagpole, see if anybody salutes. Okay, continuing. Finally, we're getting to the good stuff here. Earnings per share. What is this stock earning? Though we have to look at the corporate earnings in total, but then what we do is we divide those earnings by the number of shares of stock, and that tells us what each stock is earning, as if each stock were a little bitty factory or a little business that were earning money. Yeah, because why do we want to own a business? Because businesses are in business to earn money. And then, if the business grows, the stock price should go up, yay. And if they start paying us dividends, hey, we're going to get some money in our pocket. And to compare companies to their earnings, we use a very popular but very tricky, because there's a couple of moving parts here, and we can spend a lot of time talking about price to earnings ratio. You take the price of the stock and divide it by the earnings. It's very simple. Again, 99-cent calculator. But what does that mean? Well, we're going to see. A lower price to earnings ratio usually means the stock is a less risky investment, but not always. A higher price to earnings ratio usually means that the stock is a more risky investment, but not always. Yeah, you see what you're up against. But the actual calculations and the numerical measures are actually very easy to calculate. So here's an example on slide 27. If we have a company that has made $2,500,000, now that's a lot of money to you and me, right? Whoa, $2.5 million. But we don't know how many shares are outstanding. If there are 5 million shares outstanding, we take the $2.5 million divided by the 5 million shares, and you can just cross off the zeros. Makes life easier. And it turns out that this stock is earning, every single share is earning 50 cents. Does that make sense? That's the earnings per share. And again, we're going to do a few calculations. They're not hard, folks. But in practice, all you do is you pull up your phone or go online and you say, or download their earnings reports. And that's what we do in Business 123, Introduction to Investments. I'm going to ask you to do a little bit of that. It's not hard, dear students. Not hard at all. And so now we're going to compare those earnings per share for this company to what the price is. So let's say we go online and we see that the current price is $10. If we take $10 market price divided by 50 cents earnings per share, that gives us a PE of 20. Now the dollar signs cancel. I hate that word. The dollar signs go away. PE is unitless. Don't put a dollar sign. Don't put a percent sign. People do. You're not supposed to. Don't worry. No one's going to thwack you for doing that. But it stands alone. And this company has a PE of 20. $10 of price divided by 50 cents of earnings. 20. So is that high? Is that low? Yeah. Well, historically, slide 29, a PE of 20 or above was considered high and reserved only for the fastest growing stocks. Historically, a PE 5 to 15 was considered average. For almost 30 years, a PE of 40 to 50 was not uncommon amongst growth stocks, the Starbucks, the Googles, the Amazons of the world. I will never forget until the day I die, hopefully. I don't lose my memory. 1998. I looked down at the Quotron machine, which are basically out of business because of the internet, and eBay's PE was 10,000. And I said, "Oh, this is not going to end. This is not going to end well." And I didn't know when it was going to end. I didn't think it was going to end until at least 2002 or 3. It ended in 2000. I should have known. I didn't know. Nobody knows. But I knew. And again, eBay went down some 90%. It was one of the companies that actually survived the dot-com bubble. A lot of them are gone, and never to be remembered. But you had lost 90% of your value before it finally started coming back. Microsoft, I think, lost 80%. Intel lost 70%. Some of them lost, 90-some percent. Some of them lost 100%. They were gone. You ever hear of drcoop.com or CMGI or theglobe.com? People were putting .com at the end of their name because Amazon.com did that, and they did really, really well. And they went down quite a bit, but they've come back. The PE ratio essentially tells you what the market believes the prospects for a company are. And it also gives you an idea of how long it will take the company to earn back its price. I really should just get rid of that because it's not that important. But think about it, folks. If you're earning 50 cents a year in your stock and it's $10, it's going to take 20 years for you to earn back your price, which is, not that important, but it's just something to think about. At a PE of 10,000, it would have taken 10,000 years for eBay to earn back its price. They wouldn't worry about the Y2K problem. They had to worry about the Y5K problem. Going from 9,999 to 10. That's a long time from now. We don't have to worry about that, folks. We don't have to worry. Anyway, that's the idea. The higher the PE, the more investors believe the prospects for the company are going to be positive. The lower the PE, the more investors are not that excited. Now, are they right? We'll know in 3 and 4 or 5 years. Prediction is difficult, especially about the future. So our last measurement is one of my favorites, and that's the dividend yield and the dividend percentage. Because the dividend yield tells you how much money you're getting as a percentage of your stock price. So it's the yearly dollar amount of income generated by the stock divided by the current market price. And as we said, stocks were in the 4, 5, 6% yield. Now 2 or 3% is typical. Many are 0%. They don't pay any dividends because they're growing and they're taking that money instead of giving it to the shareholders. They're reinvesting it in the company. But some are paying more than 4 or 5 or 6%. Some are paying very high dividends. And the dividend yield allows you to compare your stocks to other investments such as savings accounts or bonds, when we get to bonds, which are loans. It's a very important number depending on who the investor is. If the investors are more growth oriented, I don't care about dividends, I want the stock to price to go up, then they're not that interested in dividends. If they're like me and they're boring and they love dividends, dividends don't lie, then dividends are a very important part of the decision they make to buy or sell or hold or whatever a stock. So here's an example. If we take a stock that's paying us $1.50 a year and the market price happens to be $87.50, we take that annual dividends per year, the absolute dollars that you get in your pocket for every share. Every share you get $1.50. We divide that by the market price, $87.50. And we get that number on our 99 cent calculator, and we round it to 1.71. And you don't want to round it to 2. No. You want to have at least 3 digits over here. 2 digits to the right of the decimal point, sometimes even 3 digits to the right of the decimal point. And it's not wrong if you had rounded to 2%. It's just not good because that means anything between 1.5 and 2.5, and that's a big difference. So use at least 3 digits of accuracy. That's what the chemists and the physicists will tell you. Or 4, 2 digits to the right of decimal point, or 3, Just make sure you don't round it to a whole number, okay? So is that low? It's a little on the low side, but not that low, because remember, savings accounts are still paying under 1%, the big jerks. But other interest rates are going up, so we'll see what happens. So now let's put it all together, and let's take a look at a couple of companies you may have heard of, Walmart and Costco. You've heard of it, right? Yeah, right, exactly. Two little mom and pop shops. And as of October 14th, 2022, the price of Walmart was $130.43, whereas the price of Costco was $450. And you might think, wait a minute, is Costco worth more than Walmart? No. Why is that? Because there are like 6 times more, 6 times more shares of Walmart than there are Costco. So the earnings per share for Walmart is $5. The earnings per share of Costco is $13. So notice the PE ratio. PE ratio of Walmart is 26, which is high. The PE ratio of Costco is at almost, 34.6, almost 35, much higher than Walmart's. So who do you think people are more excited about the prospects for? Investors are more excited about the prospects for Costco than they are for Walmart. They're still pretty happy about Walmart. 26 is still a pretty high PE. They're still optimistic, but they're much more optimistic about Costco. Well, why? Hang on a minute. Look at the book value. Notice that the book value is far less than the market price. And that makes sense. Nobody's going to want to liquidate Walmart, sell off all the assets, pay off the debts. Nobody's going to want to liquidate Costco. No, they're in business to make money, and they're doing a very good job of it. Thank you very much. So we don't worry about the book value getting higher than the market price. We don't believe anybody's going to ever want to, maybe 500 years from now, who knows, or 100 years from now, I don't know. But right now, no one's going to want to liquidate these. So Walmart is paying us $2.24 a share. Costco is paying us $3.60 a share. That turns out to be a yield on the Walmart stock of 1.72%, very similar to the one we just looked at, the hypothetical, the example. Whereas Costco is paying us less than 1%, 0.76, which makes sense, you see. Investors have bid up the price relative to the earnings more than they have in Walmart. So investors who are buying Costco are more interested in the growth of Costco, whereas Walmart investors are still interested in growth, but they're also demanding a higher dividend yield. Now here's the money pitch, right? We said very quickly, offhandedly, that Walmart has about 6 times more shares than Costco. So it turns out that Walmart is much bigger than Costco. Here's the market cap. $354 billion for Walmart, $201 billion for Costco. Both large caps, both mega cap stocks. And yes, of course, because they're all around the world now. They're fighting in markets all around the world. You go down to Mexico, there's Walmarts and Costco's everywhere, and you go all around the world. They're fighting. It was very cool. What was it? Oh, Amazon. And Amazon, we should look at Amazon also. Amazon was trying to buy this online retailer in India. They were trying to buy it. And over the weekend, Walmart swooped in and bought the company in India. So you see, these companies are thinking globally. Now, say you wanted to be the owner of Walmart. No one's going to buy Walmart, folks. Don't worry. Or Costco. They're both way too much money. But if you wanted to buy Walmart, you'd have to have $354 billion in your pocket, walk down to the New York Stock Exchange, because that's where they're traded, and say, I want to buy Walmart. And they'd say, come back with another $50-60 billion. It's not going to happen. But that's how it works. If you want to take it public, you have to come up with about 10 or 20% more than what the current market cap is. But that's what Walmart is worth, folks, on October 14th. It changes exactly every day as the markets go up and down. So that's why it's always moving. It's always changing. Let's take another look at a couple other companies that you may have heard of. McDonald's and Yum. Who are Yum Brands? What? Well, you know them as Kentucky Fried Rat, Taco Hell, and Pizza Crowd. I'm sorry, Kentucky Fried Chicken, Taco Bell, and Pizza Hut. Anyway, you look at the price of McDonald's and Yum, and you say, well, McDonald's is worth a lot more than Yum, but it turns out they're worth more than the price signifies, as we'll see. They're both earning a goodly amount of money. $8.12 for McDonald's, $4.99 for Yum Brands. But notice the PE. The PE of McDonald's is 30. The PE of Yum Brands is only 21.4. What are investors saying? They're saying they're more excited about the prospects for McDonald's than they are for Yum. Now, are they right? We'll know in 3 to 4 or 5 years. That's why it's called the future. But if you were to put a gun to my head, and I hate both of these companies because they're both responsible for a lot of deaths. And if you don't believe me, just start digging about how dangerous it is to eat a cell. You can go there once a month. It's not going to hurt you. But people go there every day, folks. They go there for breakfast and they go back there for... That stuff is bad for you. It's coating your arteries and it's raising your blood pressure and it tastes great. Right. You can make a whole lot of money selling people sugar, salt, and fat. But now this is so bizarre. Look at the book value. Both companies have loaded up on lots of debt. They've taken up tremendous sums of money in debt. And so they actually are kind of like young people who have student loan debt. They have negative equity, negative net worth, negative book value, which is fine by them. All they care about is they can service the debt. Can we pay the debt off? That's all we care about. I don't like that. I don't want to buy a company that has more debt than assets. But then I'm a more conservative investor. An aggressive investor would say, hey, what are they doing with the debt? That's the key. Are they using it to grow the earnings, grow the company? Yeah. So you see, there's coffee and tea, there's chocolate and vanilla, and there's growth versus value in the world of investing. Okay, what are the dividends per share? Well, McDonald's is paying, and Yum are paying a pretty heavy, not hefty, I should use, not outrageously so, but 2.5% for McDonald's, 2.1% for Yum Brands. That's a healthy dividend. Yeah, that's not bad. Look at the market capitalization though. McDonald's is 179, as of October 14th, $179 billion. Whereas Yum Brands was only $30.4 billion. It's still a large cap company, but McDonald's is a large mega cap company. So Yum Brands is what? 1/6 the size of McDonald's? Yeah. And that's kind of what you would think intuitively. You don't really know until you look at the numbers. But yeah, McDonald's is 6 times larger than Kentucky Fried Chicken. Yeah. Okay. So which one would you buy, if either? And so I hope what you're starting to see is that we need to start using our judgment. And we need to do our research. And there's a whole lot more research that we can do, folks. We're just scratching the surface. Take Business 123, Introduction to Investments. I'd love to see you in next semester. I hope. But remember, it's already on the website for free. If you don't enroll in the class, you don't get college credit. But if you take it for free, that's cool too. And there's a free book. Yeah. And now our last couple will be AT&T and Verizon, the duopoly, as it's called. They're basically the two giants. There's T-Mobile and Sprint, which are now one company, which are trying to break into it, but they're still way smaller than AT&T and Verizon. Looking at the price, you might think that Verizon was a lot larger than AT&T. It turns out it is larger, but not that much larger because of the number of shares outstanding. The earnings per share are $2.26 for AT&T, $4.98. So look at those PEs. Remember, we saw 30, we saw 20, 6.6, 7.3. Are investors excited about the prospects for AT&T? Oh, AT&T and Verizon. I just unplugged myself. My apologies. Is it still working? Yeah, it's still working. Okay. No, investors are not excited about the prospects for these companies. Look at the book values. The lowest we've seen relative to the price. Look at that. AT&T's market price is less than the book value. What did we say about the danger of corporate raiders coming in and raiding the company, putting the company out of business, selling off all the assets, paying the debts, and walking away with money? It's not going to happen. Folks, AT&T is too large for that to happen. It's not going to happen. But this is not a good sign from an investor standpoint, in my humble opinion. Sure, they're paying very healthy dividends. $1.11 for AT&T, $2.61, 7.5%, 7.2%. Remember we said 2.3 was a healthy dividend? 4, 5, 6 was what we used to get. We're getting over 7 from these companies. Now the question is, will they be able to continue to pay these dividends? That's a very difficult question because I don't know about you. I'd be happy to get 7% in perpetuity. I like that word, perpetuity. It means, for a long time, forever. But if their earnings fall, they're not going to have the dividends to pay to the shareholders. And what I think, and I'm not an expert in mobile phones. I hate my mobile phone, but I have to treat it nice or it doesn't treat me nice, and I need it, right? What investors are worried about is AT&T and Verizon having to spend billions of dollars to go to 5G. And then after that, having to spend another billions of dollars to going to 6G and 7G. And it's an arms race. It never ends. So I think investors are very worried about the growth prospects. I mean, pretty much everybody already has a phone. Now they have to fight amongst themselves. And the amount of capital expenditures. You might hear people say CapEx. Capital expenditures, a fancy word for money, right? They have to spend all this money to keep the technology going. So I think that's what's going on because, boy, I would be happy with 7.5%. I'd be happy with 7.2%. Would you? But would you continue to get the 7.5%, the 7.2%? And notice the market capitalization. AT&T and Verizon are both mega cap stocks. AT&T just barely, but they're both large companies, folks. But notice that Verizon is a little bit more, 153 billion versus 107 billion. And the PE is a little higher, not much higher. So people are a little bit more excited about Verizon than they are AT&T, but not much. So now, the takeaway. What I hope you've seen in this presentation is that the investigation that we do involves calculations which really aren't that hard, and it involves a lot of judgment about what's going to happen in the future. And we're going to, not in this class, but in the 123 Introduction to Investment class, we learn about more models that we can use to value our stocks. But in the very end, at the very end, after we've done all our investigation, all our research, all our models, all the valuations that we come up with, what do? We throw them away. We burn them. We drown them. We shred them because the bottom line is the end of the discussion is, would I want to own this business? Would I want to own FedEx? Would I want to own Nike? Would I want to own Walmart or Costco? And if the answer is yes, I think it's a great business, I want to be a part of that business, go ahead and buy 10 shares or 5 shares or whatever you can afford, because you can't buy the whole company. Warren Buffett says, if you wouldn't want to own the whole company, don't even think about buying the stock. Now, he's so big, he goes out and buys the whole company. His company owns Dairy Queen and Geico and Burlington Santa Fe Railroad. And so he's big enough to actually own the whole company. When we come back, we'll continue our discussion of stocks, and we hope we are piquing your interest, dear students, because stocks are exciting, stocks are sexy, stocks are risky.